Axis Nifty Midcap 50 Index Fund. Will this NFO help you achieve your financial goals? Who can invest in this NFO? Who should avoid this NFO? Let us analyze and explore. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decision. Before analyzing and evaluating this NFO, first let us understand the basic features of this particular fund. Axis Nifty Midcap 50 Index Fund is a mutual fund that invests in Nifty Midcap 50 Index. It is an open-ended equity scheme replicating and tracking Nifty Midcap 50 Index. The NFO is open till 21st March 2022. This has got Nifty Midcap 50 as the benchmark. Minimum application amount is 5,000 rupees. There is no entry or exit load. Investment objective, as we have already discussed, this fund will invest in the 50 stocks of Nifty Midcap 50 Index in the same proportion which is given in the index. Same stocks, same weightage. So the aim of this fund is to deliver Nifty 50 Midcap Index funds return subject to tracking error and the expense ratio. There are some important facts you should know about this particular index. There are 150 mid-cap stocks. First 100 in the market is large cap. Next 150 is mid-cap. Out of this 150, top 50, based on some criteria, market capitalization, top 50 is chosen. That top 50 is what forms part of Nifty Midcap 50 Index. The top 50 companies in the midcap segment are spread across multiple sectors. Financial services has got 23% weightage. Industrial manufacturing has got 11%. Automobile again 11%. IT 9%. Chemicals 6%. We have also got exposure to consumer goods, power, services, media, oil, textiles, pharma, construction, cement, telecom. So this Nifty Midcap 50 Index is not a concentrated index, it is a well-diversified index. These 50 stocks are spread across multiple sectors. So a healthy diversification is there in this particular index. And what kind of companies are there in this particular index? I have listed down the top 10 companies from this index. It is Tata Power, SRF, AU Small Finance, Voltas, Z Entertainment, Mindtree, Emphasis, Bharat Electronics, Page Industries, Shriram Transport Finance companies. So very promising companies, because this is the creamy layer of the 150 mid-cap stocks. Out of the 150 mid-cap stocks, top 50, the creamy layer is what taken and constructed as a separate index, Nifty Midcap 50 Index. And what is the kind of return this fund has delivered in the long run? In the last 1 year, 41% return has got delivered. Last 5 years, CAGR return is 17.97%. Since inception, this particular index has delivered 13.98% return. This is the past performance, but the past performance is not indicative of future performance, right? When you are investing in mid-cap or when you are investing in any equity for that matter, you should have a long-term time horizon. Because this fund has delivered in the last 1 year 41% doesn't mean that the history will be repeated, not necessarily. When you are investing in equity fund, you should have a long term of 7 years plus. This 7 years plus will have a lot of ups and downs. You have to stay the course. You can expect on an average 12 to 15% kind of returns in equity funds. As we have understood the basic structure and the outlook on the index, we have understood. Now is the time to analyze this fund with pros and cons. When we did our research, what are all our key findings which are in support of this particular fund? Now, what are all the potential merits of this fund is what we are going to see now. Pros of investing in this fund. As we have already discussed, this has got a very diversified portfolio. It has got financial services, it has got services, it has got media, telecom, pharma. All the sectors are there in this particular index. So it is not a concentrated portfolio. A healthy diversification is there. This is actually very suitable for aggressive investors because mid-cap is riskier, so suitable for aggressive investors who are looking for mid-cap exposure. This fund is definitely an apt one. As it is an index fund, the fund manager will buy the entire index. He will not analyze, he will not choose the best mid-cap stocks. No, he will buy the entire index which has got 50 stocks. He will not handpick like a few stocks out of those 50. No. Whereas in the actively managed mid-cap fund, the fund manager will pick and choose the best mid-cap stocks from the mid-cap index. Right? He does his own analysis. He checks the balance sheet, he checks the profitability, sustainability, the management quality, long-term vision of the company, the sector outlook, everything he will analyze and then pick and choose the particular company. When he does this analysis, he can go wrong and may end up choosing a poor stock. So this creates a stock selection risk. This is known as fund manager bias. This particular fund manager bias is not there for any index fund because they are buying the entire index. This particular Nifty Midcap 50 index fund from Axis removes the stock selection risk. This fund is aimed for long-term investments and the aim is to generate capital appreciation in the long term. Yes, short term, the fund can be volatile. In the long term, the fund can give you inflation beating return. This fund has got a potential to give inflation beating returns. As it is an index fund, there is no fund management expenses or very less fund management expenses, I would say. Because of that, this fund will enjoy low expense ratio compared to an actively managed mutual fund scheme. These are all the key observations when we researched this particular fund, key observations which are in support of this particular fund. Now we are going to list down the key features which are against this fund. Key observations which are potential demerits, drawbacks, disadvantages of this fund. The risk factors for this particular fund is what we are going to look at now. This fund being a mid-cap fund, not suitable for conservative investors, and it underperforms index at times because of certain factors like tracking error and expense ratio. As it is an index fund, this will not beat the respective benchmark index. This will mimic, mirror, and replicate the index. So this will not be able to beat the index. In an actively managed fund, the fund manager will pick and choose the best stocks. Because of that, he has got better potential to outperform the index. Here, it is not possible. He is going to buy the entire index in the same proportion. He will not be able to beat the market. He will not be able to generate any alpha. People go to mutual fund because they don't know how to pick and choose the stock. That is why they go to a mutual fund manager. Here, mutual fund manager is not picking and choosing that. So it is one of the major drawback or potential demerit of this fund. Normally, in an actively managed fund, the fund manager will move from financial services sector to IT to media to telecommunication based on the outlook. If the outlook is brighter in one particular sector, he will have higher exposure. If the outlook is negative in one particular sector, he can reduce the exposure. He can dynamically, actively manage the fund. It is possible in the actively managed fund. Whereas in the Axis Nifty Midcap 50 Index Fund, the fund manager is not going to actively manage it based on the market outlook. He is going to simply follow whatever the allocation given in the index he is going to follow. So here, managing the fund based on the market outlook dynamically is not possible. This fund manager of Axis Nifty Midcap 50 Index Fund will not do any analysis on the underlying stocks in this fund. He will not look at the balance sheet of these stocks. He will not look at the past track record. He will not look at what kind of dividend history they have got, what kind of profitability they have got. Do they have cash reserves or not? What kind of debt they have got, they will not look at. What kind of transparent management they have, what kind of quality management they have got, what kind of moat or competitive edge these companies have got. Nothing is analyzed. They will simply look at what are all the constituents of this particular index. These are all the 50 stocks. This is the weightage. They will blindly go and buy the entire 50 stocks in the same weightage without having any second thought. No analysis is done. So it is a blind risk an investor is taking. Whereas in the actively managed fund, the fund manager has got a higher potential, better opportunity to take calculated risk. He can do all the analysis and choose a stock. So taking calculated risk is possible only with an actively managed fund and not with an index fund. Tracking error is another drawback. Because of that, the overall return can be reduced. When a particular sector is not doing well, or when the market is going to be bearish, the fund manager in an actively managed fund can take proactive steps. If the market is going to be bearish and if the trend is bearish, he can move the portfolio to defensive stocks. When the particular fund or when the outlook is really bullish, he can change the portfolio to growth stocks or momentum stocks. This kind of proactive action is not possible with index fund because they have to simply follow the index. They can't do anything on their own. After the market crash or after the market crash or after the market recovery, this fund will not be able to course correct themselves. They will not be able to correct the direction. No, they should not do any course corrective action. They should not take any proactive action. They have to simply blindly follow the index. These are all the key observations which are against this Axis Nifty Midcap 50 Index Fund. Now, what is the final takeaway? As an investor, do I have to invest in this fund or I should avoid this fund? It depends upon what kind of investor are you. Yes, if you are an aggressive investor who is looking for mid-cap exposure and not willing to invest in actively managed fund, because actively choosing an actively managed fund is not part of your competence, then in that case, going for this fund may be one of the options. But one thing is there are existing funds in this particular category where they have already lower expense ratio and low tracking error. Why should we try this untested fund? Is something needs to be answered. There is no answer for that. So instead of choosing this NFO, even aggressive investor who is not willing to invest in actively managed fund has got an option to choose existing Nifty Midcap 50 index funds. For investors who are looking for large cap or small cap exposure as well, this fund will not be suitable. Right? If you are looking only for mid cap, then fine. If you are looking for large cap or small cap, this fund is not suitable. Actively managed mid cap funds has got better potential to deliver more returns than this fund. If you are looking for market beating returns or dynamic fund management, then definitely this fund is not at all suitable to you. If you are an investor who want to invest in a fund on an experimental basis, then you can try with a minimum amount in this fund. If you have any questions on this particular fund or any other investment options or anything related to your financial goals, feel free to book a free appointment with our financial planner. The link for booking the free appointment is given below this video in the description box. Will you be interested to attend insightful investment webinars? If yes, we are organizing regular insightful investment webinars for free. The link for the next webinar, upcoming webinar, is given below this video in the description box. Please register today for the upcoming webinar and book your seat so that you will quickly learn good investment strategies to create long-term wealth. If you like this video, please give a thumbs up. If you know anyone in your social circle who would be interested to watch this video, please share it with them. If you have any feedback to this video, please share it in the comment box. Last but not the least, please subscribe to our YouTube channel if you are not subscribed so far. Thank you. Bye.